After studying this module, we shall be able to understand the concept of performance evaluation of portfolios. Secondly, we will learn about the measures of return. Thirdly, we will explain the weighted measures of return. Fourthly, we identify the measures of risk. And finally, we analyze the parameters of portfolio performance evaluation. In this module, we shall study about portfolio performance evaluation that aims at measures of return. The performance evaluation of a portfolio is nothing but checking out whether a target level of activity has been achieved or not, or how well the portfolio has performed in comparison to other portfolios or market index. In other words, it is an assessment of the functioning of the portfolio, its risk and return. In fact, the performance evaluation of portfolio is nothing but evaluating and examining the overall performance of the portfolio managers or asset management companies. The performance of a manager is indicated as active fund manager, who aims at aggressive, likely to have high return and high risk, and passive fund manager, who aims at less aggressive, likely to generate less returns and less risk. Such an evaluation of performance of portfolio manager is important to an investor for the following reasons. First, it helps the investor to examine how well the manager has achieved the targeted rate of return. Second, it enables the investor to examine how well the manager has achieved the desired targets in comparison to other portfolios. And the third, it helps to evaluate the performance of investment decisions in relative terms, that is, per unit of risk. Now question arises, how can we evaluate the performance of portfolio or portfolio manager? The key parameter of portfolio performance evaluation are rate of return and risk. We start with measuring the rate of return. The rate of return on an investment is estimated for a specific holding period. It is a simple concept in the case of one period investment. It is simply the total proceeds from an investment divided by the initial investment. The proceeds from an investment includes both the cash distributions as well as capital gains or loss. In other words, the rate of return of a portfolio is measured as the sum of cash received, that is dividend, and the change in the portfolio market value, that is capital gain or loss, divided by the market value of the portfolio at the beginning of the period. Mathematically, we can write as return of portfolio is equal to cash in terms of dividend plus capital gains or loss divided by market value of a portfolio within bracket purchase price, or in other words we can also write like this: the return of portfolio is equal to dividend income plus terminal value minus initial value divided by initial value. We can show these factors with the help of example. So first example is, consider a stock with current market price of rupees 100 paying a dividend of rupees 4 annually. You purchase the stock today and earn and collect rupees 4 dividend and sell the stock at the year end for rupees 106. So here the rate of return will be calculated like this: rate of return is equal to total proceeds divided by initial investment, that is dividend plus capital gains divided by stock purchase price at the beginning of the year. By putting these figures in the formula, we get 10% rate of return. So we can say that mutual funds or managed portfolios are specially designed portfolios. Investors invest their funds in the form of different schemes with the specialized institutions or asset management companies that are able to invest the investors' fund across different industries and different securities, thereby facilitating investors with the benefits of diversification. Mutual funds with their skilled portfolio managers promise to generate return on investment similar to rates of return earned on other similar efficient portfolios in the market. The benefits generated from such investment activities, that is, with the help of mutual funds or managed portfolios, these benefits are distributed among the contributors or unit holders. The return from mutual fund is calculated on the basis of net asset value of each of these funds rather than from the changes in the market price of all stocks constituting the portfolios. In other words, the return on mutual fund is nothing but the appreciation recorded in the net annual value over a period of time. Return over a holding period can be calculated by using a mathematical formula, that is RT is equal to net annual value for T period plus DT divided by net annual value T minus 1 minus 1, or in other words, within bracket, net annual value for T period minus net annual value for the preceding period plus DT divided by net annual value for the initial period, that is T minus 1. In this formula, we have used net annual value for T period, that is per share net asset value at the end of the year T. Net annual value T minus 1 shows per share net asset value at the end of the previous year, or we can say beginning of the year T. DT shows distribution per share during the year T. Now we are going to understand the concept of weighted rate of return. Calculating return on a portfolio during a period of time is fairly simple when there are no deposits or withdrawal of money from the portfolio during that period. In such a case, the portfolio market value at the beginning and end of the period is considered for calculating the return on portfolio. Calculating portfolio return, however, becomes difficult when there are certain additions or withdrawal into the funds during the particular time period. Declaration of dividend by some companies and reinvestment of such flows into the units of given mutual fund further complicates the portfolio return calculations. We can use the following methods for calculating portfolio return in these cases. We start with value or money weighted rate of return. The value or money weighted measures evaluates the performance of the fund. It is also called as rupee weighted or dollar weighted rate of return. It takes into account the deposits and withdrawals from the funds. The value weighted rate of return is the internal rate of return that equates the initial investment value to the present value of all cash flows plus the final market value of the investment that occurred during the period of investment. In other words, we can say that it is the rate of return at which the net present value of the investment is zero. It is the rate of return at which the present values of all cash flows and terminal values equal the initial investment. We have one more example that shows, and in this we continue over with example 1. Suppose a second share of the same stock is purchased at the end of the first year and both the stocks are held until the end of second year. At the end of the second year, both the shares are sold at a price of 108. Total cash outlays are presented in table 1. In table 1, on the left hand side we have shown the time, that is 0112, and in the right hand side of the table we have shown the outlay. So for the initial period we have rupees 100 to purchase first share. In the second year we have rupees 106 to purchase second share. Then we have proceeds in the form of dividend and we get 4 rupees dividend from initially purchased shares. Then again in the first year, rupees 4 dividend from initially purchased shares we have got. And in the second year we have got rupees 8 dividend from second shares held in the second year plus rupees 216 from selling both shares at rupees 108 each. We can solve the average return over 2 years using discounted cash flows approach by equating the present value of each cash inflows and outflows. We can use a mathematical formula for this, that is 100 plus 100 divided by 1 plus R. By solving this problem, we get R is equal to 7.117%. This value of R is the internal rate of return or the value in rupee weighted rate of return on investment. The second method we have time weighted rate of return. Time weighted rate of return measures the performance of the portfolio manager. This method ignores the number of shares of stock held in each period. The amount of funds investment is neutralized in the calculation of time weighted rate of return because the funds have deposits and withdrawals by the investors which are not under the control of the fund manager. The market value of the portfolios before each cash flow is considered for calculating time weighted return. This measure considers only the period by period return without taking into account the amount invested in the stock in each period. We can show this by another example, that is example 3. Considering the second example, when we take the stock return in the first year as 10%, that is 106 minus 100 divided by 100 plus 4. This gives us 10% return. In the second year, the starting value of stock is rupees 106. It is sold for 108 at the year end. Here, the one period rate of return is 108 minus 106 plus 4 divided by 106. This gives us 5.66% return. So, the average of first year period return and second year period return is, that is, we say R of A is equal to 10% plus 5.66% divided by 2. This gives us 7.83%. We can say that average rate of return 7.83% is the time weighted rate of return. We have another method to calculate this rate of return and portfolio best investment. We have arithmetic versus geometric average. The above mentioned example 3 employs arithmetic average of annual returns for finding the time weighted average. Geometric averages could be used in place of arithmetic averages for calculating the time weighted return. The geometric averages explain the principles of compounding. If the dividend proceeds are reinvested, the accumulated value of the investment in stock will grow by a factor, say 1 plus R. The compound average growth rate RG is calculated by using the following mathematical equation that says 1 plus RG is equal to within bracket 1 plus R1 plus within bracket 1 plus R2 plus within bracket 1 plus R3 so on, and then 1 plus R nth item. This whole is square with 1 over n. Here RG is the return in each time period. We can use this mathematical equation in an example. This is example 4. The geometric mean of the individual rates of return in example 3 gives the time weighted return as Rg is equal to 1 plus 0.10 multiplied by 1 plus 0.0566. This whole is squared with 1 by 2 minus 1. This gives us 7.81%. Thus, time weighted return using geometric average, that is 7.81%, is slightly less than arithmetic average time weighted return of 7.83% for the same stock. This is a general property, that is geometric averages never exceed arithmetic averages. In general, the bad returns have a greater influence on the geometric technique of averaging. Therefore, the geometric averages are lower. Moreover, the difference between the two averaging techniques, that is arithmetic average and geometric average, increases as the variability of period by period returns increases. This we can show with another example, that is example 5. Consider a stock that doubles in price in period 1, that is R1 is equal to 100%, and halves in price in period 2, that is R2 is equal to 50%. The arithmetic average is RA is equal to 100 plus minus 50 divided by 2, that gives us 25%. The geometric average, that is Rg, is equal to 1 plus 1 multiplied by 1 minus 0.5 square with 1 by 2 minus 1 is equal to 0. The second period return of minus 50% completely offset the first period return of 100% in the calculation of geometric average, resulting in average return of 0. This is not the same for arithmetic average. Now we further move with understanding the concept of measurement of risk. Risk is the variability of return over a significant period. Portfolio risk indicates the expected fluctuations in the return. Risk is of two types: systematic risk, unsystematic risk. Systematic risk refers to the risk on account of economy-wide factors or risk associated with fluctuations in the market. This is called non-diversifiable risk, since this component of risk can never be eliminated. Systematic risk accounts for the total portfolio risk in a well-diversified portfolio. Then we have unsystematic risk. Unsystematic risk is associated with company-wide factors or firm-specific factors, strategies of mutual fund or AMCs for the investment activities. This can be eliminated or minimized by adopting various risk management techniques such as diversification. Unsystematic risk is zero in a well-diversified portfolio. The risk of a portfolio can be measured in various forms. The two most commonly used measures of risk are variability and beta. We start with variability. Standard deviation is commonly preferred measure of variability. In case of well-diversified portfolios, since systematic risk is zero, standard deviation can be used as a measure of risk. Sharpe and others have advocated the use of variability of standard deviation for measuring risk. Then we have beta analysis. Beta is yet another commonly advocated measure of risk. The beta of a portfolio is computed in the same way as the beta of a security. Beta measures the systematic risk component. For evaluating individual stocks and not so well diversified portfolios, systematic risk or market risk measured through beta coefficient. It could be a relevant measure of eliminating and estimating risk. Beta of a portfolio can be calculated by regressing the rate of return of the portfolio on the return on market index. The slope of this regression line represents beta. Now finally we have come to make a summary of what we have discussed so far. We start with portfolio performance evaluation is the assessment of the functioning of the portfolio, its return and risk. Then we have discussed rate of return. We have discussed the rate of return and risk are the two indicators for the evaluation of portfolio performance. Then we have discussed the rate of return is estimated for a specific holding period. Then the rate of return of a portfolio for a given period, which may be defined as a period of 1 year, is measured with the mathematical formula shown as return of portfolio is equal to dividend income plus terminal value minus initial value divided by initial value. Rate of return of a mutual fund is given by net annual value for a T period minus net annual value for T minus 1 period. This is in bracket plus D of T period. This whole is divided by net annual value of the beginning period or T minus 1. Then we have discussed weighted rates of return. Weighted rates of return are used for calculating multi-period rate of return. These are value or money weighted measures and time weighted measures. Then we have the internal rate of return that equates the initial investment value to the present value of all cash flows plus the final market value of the investment is the value or money weighted rate of return. Then we have discussed the value of weighted measure takes into account the deposits and withdrawals from the funds invested. Time weighted rate of return is period by period return without considering for the deposits and withdrawals from the funds. Then we have also discussed the arithmetic and geometric averages. The arithmetic and geometric averages may be applied for calculating time weighted rate of return. Variability and beta are two commonly advocated measures of risk.